Hello, how are you? Good afternoon. Today we're gonna be talking about if real estate investment is if real estate investment is it a good time to invest in real estate right now, or is it a good time to buy a home right now? Um, in a tax in a tax view, it's always better. I tell my clients it's always best to own a house, and it's always best to own real estate or to have a business because that's how you can save on taxes. So, in that sense, in a tax perspective, real estate is always going to be a good thing for you. Uh, but I understand that how the economy is right now, how the situation, inflation, and possible even uh, the economy, having this lapse right now, or almost in the close to being in. Oh my God, I forgot the word. A recession. We're heading to a recession, they say, and in thinking of that, sometimes I wonder why, I wonder myself if this is a good time to buy, even though that I'm in real estate and I understand about taxes. Uh, but one of the things is that you can see that historically, real estate has proven, even we just went through something 2008, and we're going through something right now. But in reality, if you see the numbers, and I'm going to show you some slides right now where I can show you that from an economist. Uh, if you can see that, especially here in San Diego, real estate market is very local, very specific. Even San Diego has different, I would say, markets. So real estate is not like it's not a national thing. It's not a county thing. It's not a state thing. Real estate is more of a local situation, and even in the local situation, there's areas that have different, I will say, opportunities, different advantages, and different disadvantages. Sometimes the disadvantage are the advantage for some investors, right? So, also in the area that you want to live, because I mean, some people want a nice house. We have that thing about HOA. We have the thing about land. We want more land. We want to build an ADU, have a unit ADU, which I'm going to talk about some about that right now. But in all sense, is it a good time to buy a property right now? Well, all I can tell you right now is that in the real estate part, uh, is that if it's going to be your first home, well, right now the prices uh, are good for you. You have the advantage that we can negotiate a lot more than we probably could like 6 7 months ago. So negotiation is on your side. We can negotiate for a better price. We can negotiate for incentives for them to pay you for the closing costs. Even right now, because of the interest rates so high, we can negotiate for them to pay for the interest buy down. So that's one thing that you have also in the part of the investment. I mean, negotiation is on the side of the buyer. I will say, depending on the area, depending on the house, of course. Like for example, if you're trying to buy trip, triplex or quadplex or different type of house, probably there's not that much inventory. There's a lot of competition here in San Diego, at least. So yeah, it depends on the property that you're buying. But I mean, there's you can see that there's some houses in the market for 3 months already, and they're not that. I mean, they're not bad looking houses. They're nice houses. So also that comes into the negotiation table, where if they have been in the market for a while, probably the sellers are getting anxious, and probably they tend to negotiate a little better for you, right? So let me show you 5 reasons why real estate investment And I'm not going to talk about if it's better than stocks, bonds, or mutual funds, or better than a 401k. Better retirement accounts are the best because that's for your retirement. Even this can be for a future. I call it a forced retirement savings. Like you buy your house and you're thinking, I'm just giving my money away, but you're renting and you're giving your money away for literally. So buying a house, at least you're building something for yourself. I always tell my clients, in 2 to 3 years here in San Diego, not all nationally probably sometimes 5 to 10 years, but here in San Diego, uh, 2 to 3 years, you're probably gonna be paying the same amount of rent for your payment that you're paying for rent right now for the same property that you have for the same space that you have. So, or we can even say 3 to 5 years. So, in 3 to 5 years, you're gonna be paying exactly the same that you right now are gonna pay for your mortgage, and probably even better because if interests go down, I mean, there's a saying that is going out, marry the price, how they say, don't marry the interest, marry the price of the house, right? So later on, you can just divorce from the interest, and you can keep the house at the price that you bought it. Because if things get better for the housing market, of course prices are gonna go up too. Prices are gonna go up because things are getting better for the housing market. So think about it. And interest rates, honestly, there's always a lot of people are saying, and also you can see it historically. You can go back and go Google it and stuff. 7% is not a bad deal. I mean, it's kind of like and honestly, I'm gonna show you a table right now. Actually, I'm gonna show it to you right now, and it's 42. So you can see this slide right here, and oh, so here you can see that you can see here how it's January 22, February 22, March 22, April 22. So the housing market is kind of like declining, right? And you can see that. And right now they're saying that we are, like 18%, 7 to 18% below the what the prices should have gone up, right? But as you can see here in November, you can see that, and then prices still went up a little bit, uh, because nationally the inflation is 5%. So in most markets, honestly, houses don't go up. They don't gain any equity like here, like in San Diego. So houses usually go with inflation. So basically, they appreciate with inflation. So basically, if inflation nationally is around 4 to 5%, in past years, average in the past 10 years. So 4 to 5%, and if you see nationally, that's what the appreciation of houses is, 4 to 5%. So here in San Diego, I wish I had those slides to show you, but I don't have them. So here in San Diego, between the last, I don't know, and if you know somebody that bought a house and their house was 500 and something, and now it's $1 million or close to $1 million, so at least 700 and something, So houses here, they go up from 18 in the last years. In the last 3 years, they went up from 18 to 25%. So that's a big appreciation. So if you see it in that sense, it's like the market is adjusting. So we haven't really saw a decline. I mean, of course, adjusting means that prices went down because in last year, as you can see, they were selling houses crazy above, and people were still offering way above the above that they were already selling them. So basically, if you put it into perspective, I think every house went up over like 3 to 5% over the price that they were appraised for. So as you can see here, basically in November, December, and January, houses actually went up. And if you go see a house today, it's kind of like still they're still not going down. They were just probably selling them way over, so they were still thinking that they could do that. But we had a little uh, change in the market, and they didn't see it, or they thought they could do the same thing, and they saw everybody selling above the market. So I think they were pricing houses like it was still COVID or something like that, you know. So let's go back to. So one of the five reasons is appreciation. Appreciation, tax-free cash flow. Talking about investment properties, the renters paying your mortgage, uh, tax deferred growth, capital gains income, which you don't pay self-employment taxes, which is a good thing, and also their tax at a different. But anyhow, in real estate, you're always at a loss. So the tax deductions are like the best thing in the world. You know, tax deduction, depreciation, and expenses. Fixing it, going to get the paycheck for the rent. Fixing here, fixing there, fixing the property so it can appreciate better. So you can rent it for higher, for more money. So, and that also bumps up the appreciation of the equity of the house. So all those five things is what makes, and thinking long term. All investments long term are always gonna be the best. Short term investments are risky, volatile, and they you have to really understand them. In real estate, I think what we will call short term investment is flipping a house, and that's very risky because you have to time the market first, the market well. You have to buy the property that it will do in at least at 30% below market. So when you fix it and if everything, you can still kind of come with a gain. And also those type of income, uh, if that's what you do, flipping, they you have to pay self-employment taxes, and it's a different. They go into a different ratio. So basically, they um, they are not passive. They are ordinary gains, ordinary income. So classifying it as a real estate investor, there's three classifications, three categories, and they have their pros and their cons. So the first one is passive investor. If you just invest in a property with somebody else, you have no participation, you don't manage the property, you don't have a decision, you don't do nothing, you just basically put the money in. So that you are considered a passive investor. um, and the only thing that you can do with those losses is deduct it against the other passive gains. So basically, like if you invest in stocks, bonds, and stuff like that, and you have some losses, basically you can deduct it against those losses. But if you have other passive investments in real estate, you can deduct it against those losses. But usually each real estate investment has their own losses, so really there's nothing to deduct. So one really, unless you had it for like more than 20 years. So, but it doesn't end there. So if you started in that category as a passive investor, so the losses get collected. So you have to actually track them because they get collected in a kind of like a future bucket. You put them there so when you need it. So let's say you actually next year probably you do buy a lot of stocks and you have to sell them, or you have a lot of losses in stock and you decide that you're just gonna get out before you lose more. Then that bucket comes into effect, and it kind of, and it's there forever. So The other category is active investors. So an active investor, basically, you have a decision. You're a decision maker, so you have a say in how the process goes, how the investment is gonna work. You manage the property. So basically, you actually participate in the decision in some of the stuff, and you're able to deduct $25,000 on your ordinary income, which means like if you have a W-2, you have something else, and anybody can qualify for that. Anybody, like, as long as they're not a passive investor, and right now we're going to talk about real estate professional. They're not a real estate professional. Basically, that's the category everybody falls in. So, active investor, the only con of being an active investor is if you're single, once you get over $100,000, that phases out. So again, you go back to the losses collected in the bucket, the future bucket. So don't think you lost them. So just put them in the future bucket, and and we're gonna need them somewhere later on if you do investments, or or if you sell the house. And that's the same with the passive investor. That bucket, we can actually use it when we sell the house. So, and also, if you're married, filing jointly. If you are married, 150. Once you have 150,000 in income, well, that 25 phases out, so you can no longer deduct. That becomes a passive loss, so you can no longer deduct it from your ordinary income. And now we come to the wonder of real estate investing, and is becoming a real estate professional, which I'm gonna say that it's not something that probably everybody should try for, because real estate professional is something that you have to qualify for, and you have to elect to qualify. So before electing it, of course, you have to see that you qualify for it. And the beauty of this category is that you can actually deduct 100% of all losses against ordinary income. So basically, you are you basically become it's like your business. Your business is, renting your homes. Your business is real estate. Um, Everything that you do, your operation is real estate, is your main operation. That's actually one of the qualifications, and you can now actually deduct 100% of all losses in your ordinary income, your W-2, your self-employment, other self-employment. I mean, you can deduct anything, but it has to be an election. I'm gonna go over that. So, real estate professional, we have to meet the three-part test. So this is kind of like the main thing about kind of like leading to qualifying to be a real estate professional. So spend the majority of the time in real estate property businesses. So it has to be real property businesses. And I'm gonna go over a few right now, but it could be construction, it can be, fixing the house, managing the rentals. It could be decorating them, going to get the rent, fixing them, taking pictures. I cannot think of any more, but basically anything that has to do with the real estate. And also, if you're a real estate professional, well, real estate agent, that counts. If you're a contractor, that counts. So basically, but being a contractor and being a real estate agent doesn't make you a real estate professional. You actually have to spend the 750 hours or more in the industry of real estate in the real property business. So that means in the rental properties or managing the properties. Must materially participate in the management of the properties. So that's another of the requirements. And the only cons of, and you say I put them separately from the other ones. The only cons of, I wouldn't say cons, kind of like you just have to, things to consider, right? Actually, I put it there. Things to consider about being a real estate professional is when you do a 1031 exchange, there are going to be higher standards for you. Short-term capital gains, they're always going to be imposed. So you're not going to get away from like the active investor and the passive investors, and sometimes they can get away if they just did three or less than three properties that they flipped. They can still get away and call them passive gains. So, and also you have to understand that you're gonna get the self-employment tax. So all your income is gonna be ordinary income, basically. That's what it is. And material participation under, well, there's 7 different tests of material participation that you have to look at. I'm not gonna list the 7 tests, but I'm gonna actually, I grabbed this from the IRS. So basically, if you see, it says to be a real estate professional, individual must spend the majority of his or her time in real property business. So that was one of the three-part tests, right? And then it says development or development of or development, construction or reconstruction, acquisition or conversion, rental, management or operation, leasing, brokerage, real estate agent, construction. The taxpayer must meet each of the following 2 time requirements. More than 50% of his or her time working in real property business. So basically what they're saying, if you have a job, a W-2 job, and you're a dentist, you're a doctor, you're a employee of any kind, and you actually work, more than 40 hours a day, more than 40 hours a week, or more than 8 hours a day in your job, or in your industry, or in your profession, and then you want to claim that that you're actually a real estate professional, it's gonna be hard to justify that, because it's gonna be hard to justify that you're full time in your job and then you're a real estate investor. That you could, because there's some people that have 2 jobs, 40-hour 2 jobs, so a week. So you could, but it's gonna be hard to justify that. More than 750 hours of service during the year. One spouse alone must meet both tests. So this is the good part. So if one of you is, the house husband or housewife, and you're just taking care of the kids, and the other person is the bread maker, how they call it, the actual person that works. So the person that is not an employee or doesn't have a job, a full-time job, that person or that person can be the real estate professional. So that can be classified as a real estate professional and make the election. So once one of the 2 qualifies as a real estate professional, basically the household, in a sense, qualifies as a real estate investor, and you can take all the benefits of all the properties, even they're there on your name, on your wife's name, or husband name, whatever. So in addition, service performed as an employee do not count unless the employee is at least 5% owner. And that's where I said, it doesn't matter if you're in construction or if you're in a real estate agent or a broker, you actually have to be 5% owner of that brokerage, of that construction company, so in order to kind of to qualify as a professional. Finally, before as to qualify as the hours for that, that business that is yours. And finally, before rental losses are deductible without being limited by the passive asset rules, the taxpayers must materially participate in each rental. So basically, that's the participation part, that you actually have to do it in the properties, the rentals. So that's the other part of it. And like I was saying, real estate investing could convert to your forced retirement, And even let's not talk about real estate investing. Let's talk about you buying a home, buying your own home, and doing whatever it takes to buy your home. In the future, in 5, 10 years, you're gonna be paying if you don't refinance or you don't take a loan on your house, the fixed interest rate loans, basically they don't change. If you don't change them, 30 years later you can be paying the same exact amount, and in 5 to 10 years it's gonna be way less than paying a rent, especially how things are going and looking right now. So that house can become, and also you're gonna have a lot of equity. Remember the equity. You're you're probably gonna owe way less. So that that cash flow that you have because you're not paying rent, and you can also transfer it to your kids and make them pay you the money. Sales tax, or sell it tax free. You can do a reverse mortgage, which I don't advise, but there's a lot of things you can do once you have a home. If there's a emergency, if the necessity may have that you need money, you can always use your own house as a bank. A mortgage payment is way less than getting borrowing money from a bank or borrowing money from a credit card. So that can also help you. And also I'm going to show you here. ¿Dónde puse ¿Dónde puse la cosa esta? No, aquí está. ¿Sí se mira? Sí. Okay. So here I'm going to show you, what is it? So you see the cons of buying a house right now is that the rates are up, purchasing power is down because of interest rates, economic uncertainty because of all that is happening with the economy, the inflation, the possible economic problems that are coming to us. But this is for the buyers, right? But we have less competition in the market, more homes for sale. In a perspective you see comparing to 2022, long-term ownership benefits, and it's nothing like 2008, so it's not gonna be that bad. The only thing is that people that didn't, they did the forbearance and they didn't save the money. That's the people that are losing homes right now. But we don't have that many either, so that's another good thing. Let me go to the other part. ¿Cuánto tiempo llevamos? So here you can see here. Let me show you here first. So you can see in this one. You can see here the rates, the interest rates, how they are going up since February of 2021. They were in the range of the 2.5, 3%. So from 3%, we come all the way over here to January 2023, and now we're at 6.30. Now today, March, we're at 7 point something. So, but with there's depending on your credit, depending on your situation, on your down payment and everything, on the house that you're buying, you can always do a buy down. And of course, because of the negotiation, availability that we have right now with the sellers, we can always get that from the seller, and because they're willing to sell their house. But you can see the interest rate. So let me show you what it looks like when you're buying a house. So see here, this is when the interest rate was at 3. Oh, they cannot, no me pueden ver mi mano. ¿Sí pueden ver mi mano? You can see here is 3% the interest rate. So $3,750, you were able to buy a house of 829 well $820,000, and now and right now with the interest rates at 7.0, the same $3,750 only buy you a house of 579 with 381,000, right? So you will say, yeah, that's what I'm saying. I'm not gonna buy a house right now. So think of this. Right now, houses are not going up as the usual. Remember, I said appreciation before in San Diego was 18 to 25%, depending on the area. So right now, appreciation is less than 5%, kind of like at the national level. In other areas in the United States, there's no appreciation at all. Actually, there's declining. Declining appreciation. The houses are actually losing value. Houses that already have the value. So till now, here in San Diego, I haven't heard of anybody that their house went down, that much. So if you buy right now, probably you're gonna buy less house for the same payment, but probably you're gonna be able to afford a house because the prices are kind of like they're still kind of low and they're not gonna get there. But once the market's getting better, probably the interest rate is gonna go lower. But then we're gonna go back to probably that appreciation of, instead of less than 5% or 4%, it's probably gonna be the same, like 15 to 25% over. And houses are gonna be, like I said, in like 3 years ago. Actually, a friend of mine, when did he buy his house? I think it was 3 years. 3 years ago, he bought his house. Right, his house was only worth 525,000 or something like that. 550. You can even put it 550. Right now, that same house, with whatever is happening and everything, 3 years later is worth 900,000, over 900,000. So that's almost 370,000 in just 3 years. So you can do the math on that. I'm not gonna do it, but that's what I'm saying. That's what I'm saying. It's like, it's crazy how here in San Diego houses go up so high. Actually, I was thinking of buying in a nearby Mission. What is it called? Mission Bay. And before, houses there were in the six something, close to the 700s. Now I'm out of the market. I cannot even buy there if I wanted to. So that's a perfect example of what's happening with the market before. And right now, that's why, I forgot the saying, but something like that, like marry the price, and later on you can divorce the freaking rate. But that's an example there that interest rates actually, and also we can have that interest rate just stay at that level. Like that's usually a normal. What was not normal was interest rate being at 2 point something percent. So that was not normal. This is kind of like a normal thing if you see it historically. So 6%, 7%, that's a normal thing. So probably to stay there in the normal thing of interest rates because of how inflation is good, because of the possible economic thing that is coming to us. So that's what we're seeing, and then let me show you this 27. Okay. You can see this San Diego County existing a single family residence cell growth, right? So you can see in 2020, so that's the blue. So this right here is under 300. So right now our market is in, well, our median market used to be 650. So actually came back to be a 650. So let's say we're right here, right? 650. So you can see how the trends in the, you know what? I don't understand this. I forgot about this. What I was gonna say about this. Probably is the other one. No, it was this one. So basically, you can see. I think it was this one. So basically, you can see how the growth was in those different markets. In 2020, you can see that in that market was like around 3% in the San Diego County area. In 2021, in that same market, actually, it went down 23%, and in 2022, 50%. What am I confused here? I don't know what else. Let me see if I have it in my notes because I don't even know what I was going to say about that. And okay, sorry, the human in me kicked in and I don't even remember what I was going to say about that. So let me go back to my slides. Never mind. Si se miran los estos. Okay. So, in a sense of, and I'm going to be done very soon. ¿Cuánto tiempo llevamos? De 8. Voy a acabar rápido. So, in a matter of saying, real estate investing is good for tax savings, wealth growth. Oh, actually, that's what I was going to show you. Not that slide. That's why I didn't even know what I was going to say. So let me pull it up. It is the 40, no el 30. This is what I was going to show you. So, homeownership, they put it here, the only path to wealth accumulation. But this is a statistic pulled up from the U.S. Census. And basically, you can see the wealth growth of the different scenarios. Renters are in the yellow. Owners are in the blue, and all families are in the in the light blue. So let's concentrate on owners and renters right now. So as you can see in this line, that renters are stagnant, like their line is stagnant, so there's not that much of wealth growth in the years since 1989 to 2019. If you can see, probably their wealth growth that you can see there is probably just, inflation and, payroll increases or something like that. But you can see the owners, how their wealth actually is growing little by little, but it's growing. And just that fact alone, owning a house gives you that, I would say, that advantage of getting there in the wealth growth, because you're gonna, like I said, you're gonna build equity, which relates to having your own bank if necessary. You're gonna pay less mortgage payment, which complies to paying less rent as the times go by, as long as you don't do any refinance, or even sometimes if you do a refinance, take the money out, you're still gonna pay less for the space that you have in money than paying rent somewhere else. And plus, you can do whatever you want with your house, which is not the case with, unless you're an HOA, which is not the case in an apartment in a rental property, right? And also, the thing that you have is, like I said, you have this other factor that probably can be coming to your retirement. It can you can actually inherit them to your kids. Your kids now have some wealth. Probably that one house can buy three houses for your three kids, or keep for the down payment of the three houses for your kids. You can get money from it, like a reverse mortgage, and go by, live your last years. Probably you can sell it in other terms, like I will sell it to you, but you have to let me rent here for free, and once I pass away, you keep the house, or something like that. You can even rent some parts of the house because you don't need it. You can go live with your kids and rent the house, and have some income from it. You can go to another country and rent the house. I don't know. There's so many things we can do with owning a real estate. We can even, if we only had been paying the house, and we had a low income job or something that barely gave us to, because the kids we had, and we have to support, and holding the household. So then when you owe less money and now you have some equity, probably you can take it out and invest it in your retirement fund, and start building your retirement a little more aggressively, because now you're 40, 50. So owning a house can help you a lot. And thinking about it right now, because you know what they say, I always tell my clients, when is the best time to buy a house? I said yesterday. Yesterday was the best time to buy a house. You're already a day late. Already a day late. So think about it. You know, put it in your plans. Owning a house, owning an investment, real estate, is one of the best things you will do, and you will definitely remember it when 5 years later, 10 years later. And always, like, when people want to come into real estate, they always say, I haven't experienced it myself because I'm still working on it, but they always say the first three are the hardest one. After that is easy, and it could get, you just have to keep working hard to find the good deals. But the first three are always the hardest ones. But after that, it's kind of like, it makes it easy, because now you have three banks that can help you out. And well, that's all I wanted to say right now. I don't have no fancy smooshly, like bad drawing that I do. So think about it. Think about it. Think of owning your own house, first of all, and or rental assets. If you still live with your parents, or they allow you to live with them, think first about your investment home, and then after 3, buy your home, that your investment homes pay for it. So that's a way you can think also. Don't think only about San Diego, which is very expensive. Think about it like I'm considering buying in another state. So that's what I want to say, another state. I cannot believe I forgot how to say another state. So I'm considering buying in another state. So I just wanna let you know that thinking about owning a home is the best thing you're gonna do, and thinking about buying real estate for investment is historically has been proven that is one of the safest investment there is. We already have been through the 2008. That's the perfect example. We're going through this, and I know we're gonna go past this too. So real estate is a safe investment. And also, you know what? If you don't invest in real estate, just invest in something you know. Open a business, buy some stocks, buy some bonds, fund your retirement account, because it's gonna come a day where you're gonna think about this time when you were listening to this, and I want you to be thinking of this, and always, 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 always know that tomorrow will come. And the only thing that will come is tomorrow, and that we're gonna die. But I wait for tomorrow better than dying. So thank you. Have a nice day. Please subscribe to the channel. Thank you, Juan Lemos from Nanche Life, and thank you for being here helping me. When he helps me, everything is smooth and nice. Oh, y saludos, José González. Gracias. I will respond. And thank you. And if you have any questions, please let me know. Message me, text me on YouTube, on Facebook, and I will definitely try to answer your question as soon as possible. And if you want to talk about something, remember, taxes, tax planning, tax advising, real estate, life insurance. And we're here for you, to make a better lifestyle for all of us. So thank you. Have a nice night.